Hey everyone, welcome back to Corporate Decoder. Today, EQIX just filed its quarterly report, and I'm seeing some interesting trends in their real estate and debt management. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is growing its revenue significantly, but also taking on more debt to fund that expansion, which is a key area to watch. Equinix Incorporated is a major player in the data center world. Think of them as the landlords for the internet's backbone, providing the physical space and connections for companies to house their critical computer systems. They operate globally, which brings both opportunities and risks. Now, before we dive into the numbers, let's quickly touch on their risks. Companies like Equinix are always managing a complex web of challenges. Some of the big ones highlighted here include the uncertain global economy, supply chain issues that can impact construction, and the ever-present risk of cybersecurity breaches. They also point out risks related to their expansion plans like potential construction delays and the high cost of power. Plus, being a real estate investment trust or REIT comes with its own set of rules and potential tax implications if they don't follow them. Alright, let's get to the heart of it, the financial tables. Looking at their balance sheet for the 30th of June 2026, we see total assets standing at a hefty $41.1 billion. On the flip side, their liabilities are also substantial at nearly $26.7 billion. This tells us they are using a lot of borrowed money to finance their operations and growth. A big chunk of their assets, over $25 billion, is tied up in property, plant, and equipment. This makes sense for a company building and operating data centers. Digging into liabilities, their senior notes alone amount to almost $18.5 billion. This is a huge amount of debt, and it is a critical factor when we think about their financial health and flexibility. On the equity side, their additional paid-in capital is over $22 billion. This represents money investors have put into the company beyond the par value of the stock. Now let's look at how they're making money for the 3 months ending the 30th of June 2026. Equinix reported revenues of $2.6 billion, a solid jump from $2.2 billion in the same period last year. That is a nearly 16% increase in just 3 months, which is pretty impressive. Their income from operations also saw a nice boost, climbing to $665 million from $494 million. This shows they're becoming more efficient at turning revenue into profit from their core business. And for the stockholders, net income came in at $479 million for the quarter, up from $368 million last year. This translates to basic earnings per S-share of $4.86, up from $3.76 last year. So on the surface, things are looking good in terms of growing sales and profits. When we look at cash flow for the first 6 months of 2026, we see they generated $1.78 billion from operations. That is a slight increase from the previous year. However, their investing activities show a significant outflow of $2.57 billion. This is mostly tied to buying property, plant, and equipment, meaning they are heavily investing in building out more data centers. On the financing side, they actually used $6 million, a big change from the over $1.2 billion provided in the same period last year. This shift is mainly because they repaid a lot of debt in the first half of 2026. The notes to the financial statements give us more detail on these numbers. For instance, under basis of presentation and significant accounting policies, we see they are operating as a real estate investment trust, or REIT, for tax purposes, which has specific rules they must follow regarding income and distributions. Under revenue, their contract assets and deferred revenue show a steady increase, reflecting growth in their customer contracts and future obligations. They have a massive $15 billion in remaining performance obligations, meaning future revenue already contracted. That is a strong indicator of future income. In the notes on equity method investments and variable interest entities, we see Equinix has significant investments in joint ventures, particularly for their xScale data centers. These are large-scale projects, and their investments in these ventures are substantial, totaling over $750 million. They're also dealing with variable interest entities, or VIs, which are complex structures. They've outlined their maximum exposure to loss from these entities at $1.6 billion. This is a significant contingent liability to keep an eye on. Back to debt, the debt facilities note details their various senior notes. They've issued a lot of debt with amounts ranging from short-term notes due in 2026 to long-term notes, stretching out to 2052. The effective rates vary, but the sheer volume of debt is a major financial consideration. They also have significant lease obligations with over $5 billion in total lease payments due under operating and finance leases. This is another form of financial commitment that impacts their cash flow. Looking at their equity roll forward, we see their total stockholders' equity stood at nearly $14.4 billion as of the 30th of June 2026. While they are generating profits, a significant portion of their balance sheet is made up of debt. In the segment information, we see their revenues broken down by region: Americas, EMEA, and Asia. Pacific all show strong growth. Total revenues for the quarter were $2.6 billion, up 16% year over year. Their adjusted EBITDA, which is a measure of operational profitability excluding certain expenses, is also strong, totaling $1.4 billion for the quarter. This indicates their core business operations are performing well. The cash flow statement for the 6 months shows operating activities brought in $1.78 billion. However, they used $2.57 billion in investing activities, mainly for capital expenditures on new data centers. Financing activities showed a net use of cash of $6 million. This is a big shift from the previous year when they received over $1.2 billion from financing activities, largely due to new debt issuances. This suggests they are now paying down debt rather than taking on a lot more. The report also discusses non-GAAP financial measures like adjusted EBITDA and AFO. These are tools management uses to give a clearer picture of ongoing business performance, excluding items like depreciation or stock-based compensation. For example, their adjusted EBITDA for the quarter was $1.4 billion. Now, let's revisit those risks in more detail. The macroeconomic environment, including power costs and supply chain challenges, is a significant concern. They're seeing higher costs for electricity and materials, and potential chip shortages could affect their customers. This could lead to slower sales cycles and increased competition. Specifically on power, they rely heavily on third parties for electricity. Any outages, shortages, or significant price hikes could really hurt their business and customer relationships. This is especially true as AI applications demand more power per server. Cybersecurity is another major point. Equinix has experienced breaches before, and they acknowledge they're not immune. A significant breach could disrupt operations, damage their reputation, and lead to substantial costs. And back to that debt, with nearly $18.5 billion in senior notes alone, their substantial debt is a significant risk. It means a big chunk of their cash flow goes towards interest payments, limiting their flexibility for future investments and potentially making it harder to raise more capital if needed. This is a common concern for companies with a heavy debt load. When a company has this much debt, it is similar to how companies like Bed Bath and Beyond or Rite Aid struggled with their debt burdens in their final years, facing limited financial flexibility. Their joint ventures, particularly the X-scale projects, are a big part of their expansion strategy. However, they acknowledge that the benefits might not come as quickly or as fully as expected. Managing these partnerships also comes with risks, especially if their partners have different priorities. Finally, it is worth noting that their results can fluctuate. While they are showing strong growth this quarter, future results depend on many factors, including the timing of new data center openings, customer demand, and overall economic conditions. So, what is the verdict here? Equinix is clearly in a growth phase, expanding its global footprint and revenue significantly. Their core operations seem strong, reflected in their adjusted EBITDA. However, the massive amount of debt they carry is a constant factor that could limit their flexibility and increase their financial risk, especially if interest rates rise or economic conditions worsen. The other big story is their continued heavy investment in new capacity and joint ventures, which is great for future growth but also means they are committed to significant capital expenditures for years to come. The risk I am watching is how they manage that debt load while continuing to invest so heavily in expansion. What I am actually looking for is a clear strategy for debt reduction or a consistent ability to generate free cash flow to service it comfortably. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. You can find the research tools I use linked in the description below.